Oh man, the entire real estate market's demise could end up being an anchor for the stock market for over another year. There's a new report just out that is absolutely devastating on inflationary induced aspects from real estate, and we're going to talk about that in this video, and it's a disaster. I'm going to start with some initial data and just to catch you up to speed. First of all, I'm a big fanboy of real estate and buying and holding real estate long term. But this January, I made the decision to sell all of my rental properties, and I'm not a landlord right now because I wanted to sell my properties at what I thought would be the top of the market. So far, that has proven to be true. And I've started a company called House Hack, which is now accepting money from accredited investors. We've got a deadline of October 31st coming up, by the way. That's a big deadline for free call options that you get. Well, they're warrants technically, but read the PPM on the website for more details. And we expect to go bottom feeding for real estate once the market actually continues to fall. But the data that we have now suggests it could take even longer than previously expected for the market to bottom, which is actually bad for the stock market. Not only because interest rates are skyrocketing, just look at the basics of the 10-year treasury yield, which we've talked about for years on this channel, that mortgage rates follow roughly the 10-year treasury yield. And we thought the highs of this summer were bad, which were right over here around 3.5%. Now we're sitting at 4.1 for the 10-year, and some folks are saying this is going higher, potentially to 5%. This is leading mortgage rates to absolutely skyrocket. Now remember for a moment the rule of 10x. When interest rates go up 1%, home purchasing power goes down by 10%. That's because the amount of money people have to pay on a monthly basis skyrockets when interest rates skyrocket. It makes logical sense. And since most home buyers use leverage, whether they're investors or not, whether they use cash initially and then refinance or not, they end up using leverage in real estate to increase their returns. Higher interest rates are a big problem for the real estate market. We know that. In fact, mortgage rates were sitting around 2.5% in December of 2021. Where do they sit now? Well, for a 740 credit score, you're sitting somewhere around 7.28%. Way higher. I mean, we are talking about 5 percentage points higher. That's a 50% decline in buyer purchasing power. That's way worse than we even expected at the beginning of the year. Thought rates might go to, 5.5 to 6%. Now they're at 7.25%. Absolutely insane. On top of that, we see that cancellations have skyrocketed. We have had 60,000 home purchase agreements cancel in a single month per Redfin. That is the highest on record when you take out March and April of 2020 when everything came to a sudden standstill. That's scary. Highest amount of home cancellations on record. And we're not just talking about new construction builders because we already know they have a disaster going on. Days on the market is now averaging 50 versus 31 in May. That's almost double. And that's per the St. Louis Federal Reserve. That's scary as well. Supply, 27% greater supply. It's even gotten to where buyers are now asking for more repairs because they have more power, more leverage over sellers. There's a prop tech inspection and repair company called Punch List USA. They work in like 14 different cities. The average work order last year was $2,537. Now it's $3,831. That is an average of a 37% increase, way higher than the increase in inflation because we're seeing buyers asking and demanding for more from sellers. Personally, I don't even think they should be buying. I mean, they better be getting a smoking hot deal if they're buying right now, but whatever. Now, we're also, or have already seen prices come off tops, right? We've seen prices come down about 6.5%. We've already seen that happen. But interestingly, we've kind of seen that decline stabilize over here in the last few weeks, right? But what I want you to see is go to price drops, because price drops tells you what's going to happen with prices before you actually see the change in prices. Go to price drops. What did you have happen here? Price drops skyrocketed the entire beginning of the year. Then they plateaued because interest rates plateaued for a moment. Look at it, okay? Jump on over to this particular chart right here. In this purple box, you could actually see that interest rates came down for a moment. See that? We kind of peaked in the summer and then they kind of came down. That led price drops to level off. See that leveling off right there? Okay. Now go back over here to median sales price. You see prices came down when rates went up, leveled off. What do you think is next? The next dog leg down and prices going down. Then once we get to the peak, so about, in this case, you've got a Redfin national average peak. The peak was different in different areas. You've had peaks somewhere in February for some markets, June for some markets, April for others. But nationwide, the peak was somewhere around May. May, year over year, when we get to March, April, and May of 2023, we're going to look back at these high numbers and go, oh, wow, prices are down like 10 or 15% from a year ago. How much fear is that going to cause in sellers, leading potentially more sellers to sell? Now, of course, we have this bias that, people are going to be stuck. Because why would you sell if you have to go buy a new property? Fine. But it's not just people who have to buy a new property who sell. Divorcees, deaths, foreclosures, although we expected the foreclosure part to be nominal, people who have rental properties who are just dumping, pension funds and institutions who are dumping to prevent margin calls on, let's say, their bond portfolios. Lot of things that could go on over here that could really lead to a lot more inventory beginning next year, especially when we start getting that fear. But what is the big new report that is now suggesting we could have massive, mega pain for the stock market for longer because of inflation lasting longer? Well, folks, it's out from Goldman Sachs, and I hate to bring it up, but we have to bring it up. Right after I again remind you that if you are an accredited investor, please check out househack.com. Learn about how we are starting a startup that we will use to bottom feed in the real estate market and diversify our allocation to real estate, whether it's single family, multifamily, short-term rental, long-term rental, you name it. And make sure we get wedge deals, buying deals below market value in whatever markets we're participating in. So that way, not only are we trying to time buying a lot of real estate towards a bottom, it doesn't have to be right at the bottom, but once we start troughing, right, that's when we want to go shopping, we'll buy cash, and then we'll refinance when rates come down a few years later. We'll take our time with it. We'll manage these properties in-house, and we'll have an opportunity for people to diversify away from the stock market, essentially, by investing in real estate. Now, if you're not an accredited investor yet, don't worry. We expect to have non-accredited investors eligible to invest as soon as January, maybe February of 2023. So stay tuned for that if you're not accredited. If you are accredited, you can go to househack.investready.com, click the link in the description, get your accredited investor letter, submit it to househack.com, and you can contribute to people who have already wired us over $20 million of funds for this startup. That gives us over $60 million of buying power for real estate. That could be $120,000, $500,000 homes. Just saying, we're going to be growing. If you want to get in with founder shares, now's the time to get in. But folks, what is this report that we need to talk about? All right. So this report out from Goldman is the following. When we look at the measure of rent, how rents are going up, because rent is a big part of inflationary data, we can see that current asking price-based rent is actually sitting at a year-over-year rate of 9.4%. But we expect that to actually already have peaked, if not start trending down. The problem with that is that even though rents went up, hit a peak, and are now trending down, CPI measures rents differently. And we actually think that CPI right now is measuring at about 6.8% shelter inflation, but it should be peaking at 10.3%. Now, why is that bad? Why is it bad that the chart looks like this? That actual rents are starting to trend down, that we have an inflection point to the downside in actual rent, but we have an uptrend over here in CPI rent. Why are we seeing this right here? Well, it's because inflation data measured by CPI uses something known as the owner's equivalent rents. And the problem with that is they try to measure, hey, what are current rents for people who currently have leases and what are new rents? The problem with that is you're actually measuring rent for people who've already locked in their rent for a year term. And when rents that are locked in renew, landlords don't always give them the full market value rent bump because the tenant might move, leading to turnover, which is a headache and potentially leading to repairs. Sometimes you have landlords who never raise the rent, which that's stupid. You should raise the rent every time you can. You should raise the rent. because otherwise you lag behind. Now, that might not sound so PC, but the reality is usually what happens is tenants who stay longer have lower rents than market rents over the long term. Let me give you an example. A property renting for $3,000 a month might now be renting for $4,000 a month, but a tenant might only get a $100 or $200 rent hike. That might seem like a lot, but they're still getting an $800 discount to market rents even at that $200 rent hike. But you can't give them the full $1,000 bump because, again, they'd move, you might have to deal with repairs, or you're limited by rent control limitations, which limit how high you can actually raise the rent. Even, for example, California has statewide limits that say you can't raise the rent more than 10%. Well, that would only let you go to $3,300 even though the rent has gone up so much more, in some markets as much as 30%, to give you that example of going from $3,000 to $4,000 or $3,900, right? So the problem is, when CPI measures existing rents going up, existing rents go up way slower for existing leases than they do for new leases. And so when we look at data from asking rents from all of these companies that actually track what's actually happening in the world, what do we find? Well, we find that according to CoStar and Apartment List and RentPath and Yardi and Zillow and whatever and CoreLogic, that rents have peaked and that they're trending down. But the CPI does not see that peak yet. The CPI still sees rent increasing. And this is a big problem because owners' rents and shelter inflation makes up a huge portion of our CPI. This is really bad because look at this. Cleveland Fed CPI, the average shelter inflation has made up 50% of the entire CPI measure. Core CPI is somewhere around the high 30s% of the weight that it's had over the last 10 years in measuring inflation. Look at core PCE, it's lower, somewhere around 18%, but it's still a large chunk. You look at headline inflation, headline CPI, it's around 32%. The point is, these antiquated measures of rent are going to make inflation look like it's higher for longer. They're not catching the peak. And so this is what the projection is from Goldman Sachs charted. They believe that inflation has already peaked. In fact, you could see that peak right here, right? Inflation has already peaked, right? The middle of, we're towards the end of 2022. We're right here. Every single measure that Goldman is looking at has seen rents come down. Every single measure. Yet look at that. CPI is still rising. See that rise right there? And not only that, it's expected to rise into 2023 and then actually outpace all of the other measures of rental inflation because it's so slow to actually come down. This is leading to a dirty prediction from Goldman Sachs. Goldman Sachs is predicting the following. They're predicting a peak of 7.5% shelter inflation by next spring, and that it is only likely to decelerate to 6% by the end of 2023. Now that's a disaster because even if rents were flat, we would still see CPI shelter inflation at 5%. But if rents are the way we expect them to be, they could be at between 6 to 7% by the end of 2023, which means we're likely to see inflation be much more sticky and above target for all of next year, even if rent growth was zero, because of the crappy way they measure rent-based inflation. So what does that mean? Well, what it means is a more aggressive Fed for longer. A more aggressive Fed for longer means, again, higher treasury yields for longer. The more the markets prepare to realize, or do realize, that treasury yields are going to be higher for longer, the less inclined they are to buy treasuries today. Why would you buy a 4% 10-year treasury today if you could get a 5% treasury in a month? You wouldn't. You would just wait. Well, less buying pressure on these means lower prices and higher yields. And you actually self-fulfill higher yields. And now we go full circle, folks. Higher yields on the 10-year treasury lead to what? Higher mortgage rates. Higher mortgage rates lead to more pain for the real estate market. More pain for the real estate market means what? More pain for companies like Generac, Enphase, Home Depot, Lowe's, and anyone related to the home improvement sector. This morning, We went through Generac's earnings and the preliminary earnings, and they were a complete disaster. Now, the last time we went through their earnings call, Generac was talking about and bragging about all this demand they still had. But I said, no, I will not invest in Generac because they're exposed to real estate. And I think when you're exposed to real estate and homeowners start realizing their prices are going down, homeowner prices are going down, like prices of homes are going down, they're not going to spend money investing in their homes. Home Depot tells us in their own reports, Home Depot says, homeowners consider spending on their home an investment when prices are going up and an expense when prices are going down. Well, prices are going down. So now you have expenses. So what did Generac report this morning? They reported that their growth was no longer 40%. It's now 15%. Uh-oh. Now, they are blaming delays in installations, but folks, those installation delays were also a problem earlier this year. They had supply chain issues as well. So what's happening is less residential customers are pre-ordering these systems, which Generac recognizes revenues as they're making these sales and ship them out. So they're still shipping these things, they're just not getting installed. Generac's still recognizing the revenue. So the point is, Generac clearly is getting smashed by declining homeowner demand. That means homeowners are finally spending less money on their homes. That's why Enphase is finally coming off its high horse, which it deserves to. It needs to plummet. Now, I'll buy a ton of Enphase in the future when real estate prices actually come down. That's when you want to buy those real estate companies, when they're like lows, okay? So, big bottom line here. Stick to your inflation for longer. That means stay away from YOLO bets, okay? I'm like so tempted. I'm like, treasury yields have to come down. Let's YOLO TMF, triple leverage treasury. Let's buy the bottom, buy the dip, and it's going to go to the moon. Maybe if inflation comes down and treasuries come down, maybe. But not if CPI inflation keeps it up. CPI inflation keeps everything up because of shelter inflation built into CPI, and rates and yields stay up. And they stay up longer, and if anything, they get worse. Then mortgage rates go up, then the real estate market falls even more, and then earnings for companies get even worse. It's just bad. I think with the data that we're seeing now, not only are we going to see a 15 to 20% drop in prices for real estate, but we'll probably see a 20 to 30% decline in prices, which is really going to be a big opportunity for house hack because we expect to buy below market value deals at already discounted prices. In fact, sellers are already dumping real estate, that is home builders, at bulk prices, like 20% off to companies like mine. Now, we're not buying yet because we think the market will fall 20% and then we'll get another 20% off. Like, sorry. Now, some people in the comments say, oh, Kevin, you just think it's so bad because you were trying to massage the real estate market down so you guys could go buy more. This is all just an ad for house hack. No, this is just convenient for house hack. Like, I'm trying to just give you the facts. I mean, you do what you want with the facts. You saw the reports. You see what's going on with mortgage yields. You've seen what I've been saying since before house hack was an issue. Like, well, it's not an issue, but before house hack existed, because I've been talking about this since January. I've been warning about this since January. Hey, prices are probably going to come down. Be prepared. Sell now if you need to. Like, if you're about to retire and you're like, I can't wait a whole nother cycle, sell. Now, obviously, I can't give you financial advice, can't tell you what to do, but I sold. Now, I got a lot of hate for that, but oh well. Haters ain't starting house hack. Haters didn't just raise basically $1 million a day for a startup. Haters don't read data. Haters just gonna hate. That's all right. Everybody's gonna have some of them, you know. So anyway, look, how do you actually prepare? Well, again, and I just want to reiterate this every day, increase your income, decrease your debt. Don't go YOLO. When you see a couple rallies in the stock market, don't get overly excited. Don't go YOLO. This could all last a lot longer than we expect. Now, maybe it won't. Maybe inflation will surprise to the downside, everything will fall, and we'll have a glorious rally and we'll all go to the moon. Fine, then we'll start buying homes earlier. Like, we're flexible. We could start buying homes tomorrow if we needed to. But we're not, because everything's still trending down. So you'll see when we obviously switch and start buying homes. But that ain't now. Good luck, my friends.